on PCs. What we're seeing, it suggests that we are today where we were with the internet in 1995. And 1995 through 1999 was the biggest burst in the growth sector of the market in history. It went too far, too much capital chasing too few opportunities too soon. And so it ended badly. But we're just at the beginning of this, and we're pretty excited about it. And we think that this is more on the consumer side. In the enterprise, so you've heard about the MIT study that the Wall Street Journal featured saying no productivity gains from AI.
In the history of finance, such moments are uncommon. Technology and macroeconomic forces clash every few decades to usher in a new age of economic expansion. Cathie Wood of Ark Invest claims that we are currently in a similar situation as 1995, right before the internet became widely used and drastically changed the global economy. Markets went through one of the biggest expansion waves in history at that time, propelled by optimism, innovation, and capital-seeking opportunities. It ended suddenly, but not before changing the regulations governing international trade. According to Cathie, we are already witnessing the beginnings of something rather similar. But this time the scope of invention and the prevailing economic conditions may make the upcoming years much more revolutionary. In contrast to the pessimistic predictions that fill the news, Cathie thinks that productivity is about to increase, inflation is declining, and a wave of technical advancement is paving the way for previously unheard-of economic growth. One of her greatest arguments is that real GDP growth might surpass projections and progressively lower the deficit as a percentage of GDP with the support of deregulation and innovation in industries like artificial intelligence, robots, nuclear energy, and blockchain. This assertion is not merely theoretical. During the 1980s and 1990s Reagan to Clinton transition, robust growth converted deficits into surplus. According to Cathie, a comparable result might occur in the upcoming years. Simultaneously, deregulation is bringing back dormant economic sectors. While other countries, like China, grew rapidly, the U.S. was unable to develop nuclear energy for decades due to regulatory obstacles. Those obstacles are finally coming down today. The United States is swiftly entering what Cathie refers to as a new nuclear age as a result of artificial intelligence driving exponential need for energy and processing capacity, advanced energy storage, small modular reactors, and more extensive deregulation in AI and cryptocurrency are paving the way for productivity increases that have the potential to drastically alter the course of U.S. economy. We'll dissect her most recent analysis from her monthly podcast in this video. Cathie offers a roadmap that goes against the conventional wisdom of stagnation and crisis, including topics such as the deficit, deregulation, unemployment, and innovation platforms. You will hear her complete insights in a moment, so stay tuned. Please remember to like this video, subscribe to the channel, and leave a comment below if you appreciate this type of forward-looking analysis. Thank you, and have fun with the video.
In money goes down. Savings rates go up. People are more conservative. From a cyclical point of view, we also think velocity is falling because, and we'll get into this more with the labor report, there are a lot of people who are afraid of losing their jobs because of AI, and that's in the higher income households and automation generally, and that's probably more on the manufacturing level. So I think there is concern out there. It's a question when I go around the world, everyone asks about jobs being displaced and destroyed by robots and AI. And our answer from a secular point of view is technology is a net job creator. Sure, there's displacement in the short term, but these displaced jobs are usually mundane, boring, not interesting, tedious. And there are two phenomena today that will offset any of this displacement. We have baby boomers retiring at an accelerated rate, And if you think about truck drivers, a lot of baby boomers have been the truck drivers, and there are big shortages there. So autonomous trucking, we think, is going to become very important in alleviating that labor shortage. So that's one good example. And then, of course, there has been, I think, if I might have this number wrong, but the number of people leaving this country because for reasons associated with immigration, whether it's illegal or fear or what have you, is in the 1 to 2 million range. And again, many of those jobs are in mundane areas that automation will help us improve, whether it's paperwork or leisure and hospitality work. So I think this couldn't happen at a better time, given those demographic shifts. Again, though, that said, and I suggest you do this exercise. Go to ChatGPT or Grok and ask it, prompt it. We're all programmers now. We can prompt it with natural language. What kind of jobs will automation and AI create? And in the prompt, suggest that it consults science fiction, futurists, technologists, economists, strategists, and then answer that question. And you will find a very long list is the output. One of the jobs that I find interesting, because again, it gets us thinking, wait a minute, there are whole new spaces being created, literally here. So one is asteroid mining, right? So think about space. What kind of jobs are we going to see created there? Think about blockchain and the digital world. Now that we have immutable digital property rights online, didn't have it before, but now that we do, and in a game, someone can win a Gucci skin, and it's their skin, and theirs alone, and there's proof of that. That is how a lot of young people are deriving social status these days. And that's a whole new world that is just now being monetized. I think it's one reason also we're going to see Roblox continue to flourish because it is so many things. It's not only a social site, a gaming site. Young people are actually coding and they don't even know it, and they are starting new businesses, learning how to run them. So it's pretty exciting what's being created out there, but I have to tell you, I go around the world and there's just so much fear. Again, a reason we think velocity could continue to fall. On to the next chart. So monetary policy, is it tight or easy? This chart, which Dan Rodriguez at ARK pointed us to, is the yield curve as measured by the 2-year Treasury yield relative to the 3-month Treasury yield. And anything below 0, which you see here, is tight monetary policy. And you can see it has been tight for a very long time. And we think this is going to have disinflationary, if not deflationary, ramifications with time. And it certainly fits into the narrative that President Trump and the administration have put forth, like, hey, don't you see what's going on here? And on the next page is a different version of the yield curve. It's the 10-year Treasury minus the 2-year.
Cathie starts her analysis by focusing on the deficit, which is a market lightning rod issue. She notes that tariffs and fiscal adjustments are already improving the numbers, with the deficit approaching 4.7% of GDP, despite the widespread concern that growing debt will stifle growth. However, growth itself is the true force behind this. Similar to the 1980s and 1990s, deficits may naturally decline if real GDP expansion was greater than anticipated. And Cathie says that growth is on the horizon, driven by quick innovation in a number of industries. She believes that deregulation and productivity gains could be the most effective means of reviving the economy. Her larger thesis is established by this: our future is one of acceleration rather than stagnation. However, there are obstacles to expansion. Cathie focuses her attention to the labor market, job creation, unemployment, and the structural changes that artificial intelligence is already bringing about in her subsequent research.
Your Treasury yield. Now, this is in positive territory, but if you look at past recessions, and those are in the shaded areas here, the steepening of the yield curve after an inversion tends to occur during a recession. And as you know, we've been talking about this rolling recession for the past 3 years. Manufacturing's been negative for the past 3 years. Housing has been decimated over the past 3 years. The low and middle income consumer has been hurt badly during the past 3 years. Higher interest rates, higher food prices, housing affordability, so very difficult times. Now, what I find interesting about this chart is, sure, again, we're in this rolling recession. We think it's the final leg of the rolling recession. And what I'm eager to understand, as the Fed cuts rates, this will continue to steepen. But if you look at the trend since 08-09, the trend has been down towards a flatter and flatter yield curve. We didn't get back into the 200 to 300 basis point range as the Fed was flooding the economy with money. We didn't. What was this pointing to? And we think there's an underlying deflationary narrative building into the yield curve. We'll see if we get above the 150 with this easing cycle, and we should know by the end of the year. If we don't, what that would tell us is that this deflationary narrative, I keep using the word narrative, that we have, it will raise the probability that that is correct. And that is the long bond picking up on that and not increasing as much out of fear of inflation as the Fed eases. So stay tuned on this one. Should be very interesting. Inflation, okay, lots of fear about it. This is Trueflation, the Trueflation CPI, and as of this morning, again, this is a real-time measure, and it's tens of thousands of goods and services in real time, constantly. Today, we're at 1.9%, and that's with tariffs getting into the inflation rate. They're certainly reflected in here, and I think everybody's expecting a big burst of inflation on PCs. And what we're seeing, it suggests that we are today where we were with the internet in 1995. And 1995 through 1999 was the biggest burst in the growth sector of the market in history. It went too far, too much capital chasing too few opportunities too soon, and so it ended badly. But we're just at the beginning of this, and we're pretty excited about it, and we think that this is much more on the consumer side. In the enterprise, so you've heard about the MIT study that the Wall Street Journal featured saying no productivity gains from AI, very hard to see. And I was on a panel with two people who are very senior, one heading up U.S. commercial, and we asked this question, and she said, well, it is true. What happens with Palantir is they'll go in because the CEO has asked them to come in. And they bring the CTO, CEO, all the seniors into the conversation. CTO takes it back and says, okay, well, we need to do a McKinsey study around this. So they pull the pilot from Palantir, and then 1 to 2 years later, when there are no productivity gains, they come back to Palantir with a completely restructured technology staff, mostly because there has been so much foot dragging, and they then engage. And the productivity gains that Palantir is helping enterprises evolve and enjoy are astounding, astounding. So just listen to one of their quarterly calls to give you a sense of how astounding they are. And so we think the productivity cycle is going to be very...
A mixed picture emerges from the jobs report. Job growth is rapidly slowing down, with revisions even pushing some months into negative territory, while unemployment remains stable at 4.3%. Work weeks are getting shorter. High-value industries like technology and finance are experiencing disruption, but manufacturing is still struggling. This would be a warning sign for many. However, Cathie has a different view of it. She observes indications of structural change: blockchain eliminating inefficiencies, automation and AI altering labor, and government layoffs decreasing money. Although these changes are unpleasant, they indicate increased productivity over the long run. The same reasoning applies to her market view. The rate of inflation has decreased. Spreads in the high-yield market indicate that there is little short-term danger, and treasury yields are stabilizing. However, excesses in commercial real estate and bonds also suggest weaknesses. Cathie returns to creativity as the primary motivator, though she highlights both the potential and the danger by drawing a link between the internet's meteoric rise in the late 1990s and the adoption of blockchain and AI today. Capital flowed too quickly in those days. The foundation is stronger, the technologies are more varied, and the potential impact is much higher today. This study is very optimistic for cryptocurrency investors. As Cathie points out, Bitcoin is still rising over the long run in comparison to gold, indicating that it is resilient despite volatility. Digital assets, particularly Bitcoin, stand to gain from institutional adoption as well as their function as hedges in a fast-changing economy, if her growth and innovation forecasts come to pass. Put another way, the AI and blockchain era may solidify cryptocurrency's position as a pillar of international markets. Just like the internet boom of the 1990s created trillion-dollar businesses, we are not reaching the conclusion of a cycle, if Cathie Wood is correct. We're just getting started. Even the most optimistic analysts may be taken aback over the next 5 years, as new technologies transform wealth generation and creativity propels growth. What are your thoughts? Are the markets truly in a 1995 moment right now? Tell us in the comments section. Additionally, remember to like, subscribe, and share this video with other cryptocurrency and innovation enthusiasts. Thank you for viewing.